The much-awaited interest rate hike is coming this week, and cat is already out of the bag, and we know our Jerome Powell gave us a hint that they're going with 25 basis point increase. But with Russia and Ukraine and oil touching all-time high, it makes you wonder what Fed has in store for us after this initial rate hike. So in this video, I'll share my research on how stock market might react given the Fed's rate hike, and also how many rate hikes can we expect this year from the Fed. Before I dive into the video, I just want to bring your attention to few catalysts that is very well known and few that we have forgotten or we are not talking about yet. Number one, inflation. We all know about it. It's an old story. I'm not going to bore you with it. Number two, war, Russia-Ukraine. That's also out there and we are dealing with it now, so I'm not going to go in detail about that as well. Number three, energy prices. We all know what's going on with the crude oil prices heading all-time highs, and analysts are predicting that this is going to get worse before it gets better. Now on number four is something that we are not talking yet, but it's going to be a main catalyst in the coming months, and that is midterm elections. Historically, midterm election is the time, or is the slowest time for the stock markets because of the uncertainty that it brings with it. So let's talk about how stock market is going to react given the recent rate hike, war, inflation, and elections. So you won't believe me if I tell you that S&P is still up almost 90% since bottoming from March 2020. Take a look over here. This was March of 2020 right here, 3/23/2020 or 3/24/2020. And if I draw a line to kind of show you what S&P did since then, we are up almost 95%. Like if I calculate today's price is about like 96% up from 2020. So, and now when the Fed is hiking the interest rates, do we assume that S&P 500 is running out of steam, or does it have more legs to run? Well, if we look at the history, it suggests that US stock market is poised to experience more volatility following the rise in the rates. But that doesn't translate over into the bull run is over, or that doesn't translate that the bull run is over. For us, we are still in the bull run, or for some, I should say, we are still in the bull run. In fact, in the previous 8 hiking cycles, the S&P 500 was higher a year after the first increase every single time. Let me show you in a graph and let's see what it makes or how it makes sense over here. Okay, so this is the rate hikes that we had. 1983 right here, 87, 88, 94, 97, 99, 2004, and 2015. Anytime if you see in the next 12 months, we have seen some draw in the next 3 months, and the next 6 months was also in 94, for example, we were negative 2.5% after the first hike for the next 6 months. But if you look at for the next 12 months, we have always been up, 100% we have been up on all, I would say, interest rate hike period that we had. So this is an interesting chart right here. You can see that every time the next 3 months has been a little bit more volatile, where in 87 it gained almost 19.1%, and then in the next 6 months 20.1%, but for the next 12 months the gain was only 1.5%. If you compare that to the latest hike that happened in 2015 right here, in the next 3 months negative 1.1%, in the next 6 months 0.1%, and for the next 12 months S&P gained 9.1%. So if you put the metrics down, you can see that every year or every following year, next 12 months after the rate hike, we have seen S&P perform 100% of the time. Next 6 months, about 75% of the time, because we had some laggers over here, as we can see. And then in the next 3 months after the hike, only 50% of the time, because we have seen a lot of laggers over here back in 99, back in 04, back in 015. Every time after the 3 months, the S&P didn't perform very well. Plus, in the past 3 decades, the Fed has taken on 4 distinct rate hike cycles, and technology, which has seen some wild swings this year on the prospect of faster interest rate increases, is typically among the best performing S&P 500 sectors during these cycles, with a gain of nearly 21%. Take a look over here. So this is how S&P 500 sectors perform in the Fed rate hike cycles, and you can see technology has performed almost 21%, and then real estate, then energy, then healthcare. So technology has been a winner throughout in the last, I would say, 3 different hike cycles or 4 distinct hike cycles that S&P had. So what is different this time? Will the history repeat itself? Are we going to see a bull cycle, or are we going to make our own history this time? And this will be the end of the huge bull market that we had for 2 years. 90% on S&P, man, that's not a joke. Well, this time we have something that we have never had in the past, and that is rising oil prices coupled with rate hikes along with the dilemma of Russia-Ukraine invasion and all the mess that's going on now. China is being involved as well. So it's a chart that I'm going to show it to you that basically talks about how Fed interest rate has affected in terms of the oil prices. So if you see over here, the red ones are the times when we had the Brent crude oil prices is blue right here, all-time highs like this, and then the Fed fund target rate where the Fed has raised interest rate over here. So you can see on all cycles when Fed has actually raised interest rate, you can see over here how crude oil has been. And if you pay attention, 2005 and 2009 was the only time when the crude oil prices were really high, and then Fed raised interest rate at that time. And if you pay attention to this over here, 2004, 2009, S&P actually didn't do very well following that rate hike over here. You can see in the next 12 months, it only went up 5.2%. It also went up. I'm not saying it went down, but for the 3 months, it went down. And then for the next 6 months, it was up by 6%. But overall, in the next 12 months, it was up 5.2%. So this is what's going on right now is pretty similar to what happened in 2004 interest rate cycle that we had, or 2005 interest rate cycle that we had. But the issue is now we are dealing with the war. And the war is not going to get any better in any time soon. I think we are going to see a lot more come out of Russia and Ukraine situation than what we have at hand right now. Now, the fourth point that I discussed, which no one is talking about, is US midterm elections in November. Market returns tend to be muted early in these years due to uncertainty on the outcome and subsequent effect on policy changes, but stocks typically post a strong rally at year end. Now, taken together, of course, midterm years have seen the largest intra-year pullbacks, down more than 17% as the history tells us. Not only that, this quarter and the next two are historically some of the weakest for the 4-year presidential term. Now, if we had normal market condition, this is what we had expected, but things are not the same this time, and we are seeing downward pressure on the equities and the market for many more reasons than just midterm election. Nobody's actually talking about midterm election right now. They are more concerned about the Fed hikes and also Russia-Ukraine situation. So the biggest market fear that people have is the war and the Fed right now. So if I show you a chart, so look at this, S&P quarterly performance by presidential cycle 1950 to 2021. So you can see from this very simple chart that the first quarter, second quarter, third quarter, and fourth quarter, and then midterm years, you can see the second year near the midterm is the most muted and the slowest in the stock market. And the first quarter is almost minimal, second quarter is negative, third quarter is also almost nothing, and then fourth quarter is where we jump up. But again, fourth quarter is going to be interesting this year as well. Now, coupled with the election, it's going to be really key to see what happens in the fourth quarter. Because we know that supply chain is supposed to get better by the second half of 2022. We know that war should subside. I really hope so, should subside in the coming months. So that's going to ease some pressure. And we know that more and more people are getting vaccinated. I know the China situation is not helping right now with them shutting down the factories because of the numbers are going up. But overall, more and more population is getting the vaccine and we are feeling a lot safer and things are opening up. So I think the fourth quarter may fuel a rally given if everything calms down. The war, the inflation, the rate hikes, everybody get used to it because market is forward looking. So market is already looking at what Fed is going to do for the next hike because we have already priced in the current hike, which is 0.25 basis point. But what Fed is going to do for the next hike is the key, and that's what everybody is worried about. That's what everybody wants to know. So the meeting that you are going to watch on tomorrow and also day after is going to be key on deciding how we are going to go or end this year 2022. But there is a lot to be said and there are a lot of views we can have. Do me a favor and let me know in the comments below your thoughts on the stock market on 2022. Do you agree with me that we are going to be heavily volatile and totally unpredictable for unforeseeable future? Or do you think we will have a direction in the market? Also, if you think any one particular stock, just one, will be a safe haven in these hard times, do mention in the comments below. What I'm seeing on these reports and what these reports keep telling me is one thing. That forget all the noise and just focus on dollar cost averaging in the companies you believe in. And that brings me to moomoo, as they have a great offer of 5 free stocks, which includes 1 guaranteed NEO stock if you deposit just $1. Click on the link in the description below to get the free stock, and also great app and a charting tool. I love actually using it. I recently started using it, and it's a great way to start your portfolio with 4 free stock. Why not, right? If you like the video, then consider subscribing and hit the like button. And for more one-on-one conversation, consider joining our Patreon and Discord. Links are in the description below. As always, a pleasure to share all of this with you. Until next time, you all have a sparkling day.